Good afternoon. Thanks for being with us. We're going to give it just a moment to let everyone in. Where did summer go as we're wrapping up and doing our probably last, I don't know when our September one, if it falls after the um, beginning of fall, but I think this is the last of summer. Sending good vibes to all the parents that are trying to get their kids ready for back to school. Good times. All right. I think we're in. Well, welcome to this edition of the REIA Now Update. We appreciate your being with us today. Thank you so much, as always. And a big thank you to the Home Depot Pro, who is our broadcast sponsor for all of these REIA Now calls. They have special programs for investors. Everything from the discounts of paint being 20% off, and some other special programs that you can find out about with our exclusive programs with them, including a 2% rebate. And you can do that by finding them at your local group. But before I tell you how to do that, I need to give you a quick disclaimer about our call today. This presentation, even though we're going to discuss some financial topics, that's what it's all about, and I'm excited to hear about it. This is for information purposes only. You need to talk to a professional and with the questions that you have, whether that be legal, financial, or otherwise, as you make decisions for your own business. We're here to promote, protect, and educate, and we've been doing so since 1985. Super excited to be celebrating our anniversary. We'll be doing that in October, so excited about that. You can find more information about the Home Depot program or other things, education and other great programs and discounts that we have, like a program with 1024 Wealth, which Jason's going to tell you about, that you get all kinds of special goodies with if you are a member. And you can do that by coming to the National REIA website at nationalrea.org. You can click here on I'm an investor. You're going to get a choice to either find more information about joining or about finding a local REIA in your area. So you can click on that, you'll get a map of the United States, and you can navigate to the closest group near you so that you'll get not only the national REIA benefits, but also those local benefits and connections that come along with it. Today, we're going to do a quick legislative update. I'm going to play Kevin for that here in a moment, as he is not with us today. He is lobbying on our behalf right now. And then we're going to talk to our special guest, and I'm really excited about this topic and am curious for my own sake to learn more about it. We'll have Jason Powers, who you've heard from many times, is a friend of National REIA's, and you all love to hear from him with 1024 Wealth. But he's also bringing on a power team with him, with Stephen Labella with Alpha Omega Wealth and Anthony Rushing with First Lien HELOC, to talk about some special ways that you can use his programs to get some great benefit for your investing. And as soon as I figure out how to stop sharing, I will do a quick legislative update. We really covered in depth, or Kevin covered in depth, I can't take credit for that, the big beautiful bill and its repercussions in the last call. He's also sent some information via the REIA Sense and or other updates on that. But Congress is in recess, so we have no forward movement on policy at the moment. So that can be a good thing. When they're not working, then they're not inventing things for us to be worried about. So in some ways, I'm happy when they're pressing pause, and we'll continue to update you as they come back. But the battle for control of the U.S. House is underway, with several states tackling, uno momento. The battle for control of the U.S. House is underway, with several states taking up mid-decade redistricting. One state, Ohio, which we have the privilege to watch with a front row seat here, is required by its constitution to redistrict now. The rest are by choice. Republicans argue that admitted mistakes in the 2020 census have led to GOP underrepresentation in several states. It's estimated that the sum total of redistricting efforts around the country may increase the Republican majority in the House by 12 votes. That's a lot, folks. So stand by, and we'll keep you updated on what that means for you in your state. Kevin will be issuing those updates via our emails, specifically in the REIA Sense or on REI Investing Today, which Brad does such a great job at hosting for you all and keeping you updated with. One quick thing, we are adding a benefit that goes along with real estate investing today. For those of you who are fans like I am of the Wall Street Journal subscription on Audible, where it gives you just the top of the news on a daily basis, we're going to do that on a weekly basis. So if you don't want to read through real estate investing today, or you want an overview before you do that, Brad's going to be doing just a really quick news update in a podcast format every week. So you'll get that sent directly to you. You can subscribe and or just follow us. We'll have that on Real Estate Investing Today, as well as some other ways that you'll see it. I think Lori will also is at least contemplating to see if we can put that at the bottom of the roundup. So you can click into that each week as well. So just to keep you informed on that, as well as with the REIA Sense to keep you updated on legislative issues. But that's enough for that update today. I know we've got a lot to talk about, so I'm going to try to give you as much time as possible, Jason. I will turn it over to you and let you get started to tell the group how they can move forward with what you have to offer.
All right. So we ready? You ready for me? So jump in. All right, guys. I'm going to share my screen here, and all right. You guys got a clear screen here? Let's dive in. Okay, so my name is Jason K. Powers. I am with 1024 Wealth. Many of you heard me before. We talk about the infinite banking concept and all that goes with that. And today we are adding in a whole new layer that we want to show you about, called the First Lien HELOC. We're going to kind of overlap the ideas of velocity banking and infinite banking together. So let's dive right in. I'm going to also have co-presenting my counterpart, Anthony Rushing, who's on here today. Stephen LaBella is on here as well. He'll be kind of helping out as well, jumping in here and there, maybe in answering your questions. So if you guys have questions along the way, feel free to drop them in the chat. Steve will try to get you answered along the way, but we'll definitely stop at the end and have some Q&A for you guys there too. So we're going to pull out the fire hose and turn on the water here. So here we go. So we call this the maximized cash flow strategy. It really is a smarter way just to fund your future. We're turning equity into opportunity on your home. So let's talk about what every real estate investor really wants to achieve. I think every real estate investor wants to achieve steady cash flow. I know I do when I do my real estate investing. I want access to capital for deals moving forward. I want protection against market volatility as I can help it. And I want generational wealth. I've got family, I've got kids. I want to see this last beyond just me. So I think those are important factors. But with the money that I'm building and growing along the way, I'm constantly giving away control. We do that in this country. And how do we give away control? What do I mean by that? I mean, one example is we finance everything we do, right? Cars, colleges, credit cards, everything. We finance everything. We're just taught that financing is the way. And we also lock our money up into various vehicles, right? Qualified accounts that you can't touch right now. You get penalized for touching even your mortgages, right? You dump all your money into your mortgages, can't access the equity there, or it's difficult to. And then we also put our money at risk, investment vehicles all the time. And we kind of go, okay, do we have other options out there? I love real estate investing. I love teaching real estate investors because that is another option, right? This is a amazing vehicle to put our money into that can grow wealth for us. And that's why you're all here today, is to learn how do you turbocharge what you're currently doing even. So I love this this saying. It says, we don't have a money problem, we have a thinking problem. We have to change the way we think about our money. We can't solve problems by using the same kind of thinking we used when we created them. Albert Einstein. We also talk about Nelson Nash a lot, and I'll tie this in along the way. But he says the most profitable thing you can do is learning to control your money. So it's time to think differently about that. And, because traditional thinking says, like I just talked about, we have to rely on banks. We have to rely on debt. And by doing so, we give up control. But I think we spend too much time focusing on the product. We are always looking for what's a product that will give us the best ... whatever you're looking for. What's the product that will give us the best whatever we're looking for? And I think we need to focus on the process instead more. Maybe we're putting the cart before the horse. So regain control by focusing on the process of how our money flows through our life, and then through what product or through what vehicle do we do that with. Okay, so we'll bring this in. So today we're going to cover what is a first lien HELOC, or what is velocity banking? What is the infinite banking concept? How do they work together? We're going to show you a case study or two, and then tell you, okay, great, what now? What do I do with it? All right. So let's dive in. I'm going to kick this part over to Mr. Anthony Rushing, who's on here. I don't know, Anthony, if you'll be able to take over on the slide, or if I need to stop sharing, you tell me.
Let me try and take over the control, and I'll let you know. Only one presenter can share, so I think you need to.
All right, I got it.
All right, let's see.
Handoff.
Screens. Let's do this one and share. Okay, how are we doing here? Is this? Can we all see it? Okay.
We got it. Yes.
Okay.
Good.
Awesome. So what I'm going to walk through is a mortgage product. I know that Jason said we don't want to. A lot of times we tend to focus on the product only, and one thing we're going to look at today is the process. One part of this is that the product that we specialize in and is an integral part of the process that we're going to talk about today is a mortgage product that works differently than an amortized mortgage. And we use that particular product and we understand how it works to maximize its effectiveness in line with the whole process together. So first we have to kind of understand what it is. So the product that we're talking about today is a first lien HELOC. We're going to dig into what is it, and then what's the velocity banking strategy, or what's the velocity banking process to help optimize that particular tool to achieve certain goals. So first thing, what's a first lien HELOC? How is it different from a regular HELOC? Usually when we're talking about HELOCs, we're talking about a second lien HELOC. So what we mean by that is you've got your mortgage and you open up a line of credit on top of that mortgage, and that gives you access to some of your equity. That's usually, when we're talking about a HELOC, what we think of. A first lien HELOC is different in that it has to sit in the first lien position, which means that what happens is it actually comes in and it pays off your mortgage. And so if you notice here, this is one big HELOC, one big line of credit that assumes the balance. The green section is the balance of your mortgage that it paid off, and the white section is the amount that you have available in the equity in terms of how it functions. So that's how it's different. It's one big HELOC, which allows for you to take advantage of it in different ways that can be more beneficial. So here's what people are accomplishing with first lien HELOCs. They're paying down their homes extremely quickly, as little as 5 to 7 years, paying it completely off. They're saving tons of money, tens to hundreds of thousands of dollars in overall interest by using this the right way. They're investing in different diversification opportunities to help generate income and move toward residual generational wealth type of scenario. They're creating emergency funds that wouldn't be available, and they're also simplifying their life by the use of this process that we're going to talk about in a second. So how are they paying off their homes so quickly? That's sort of the thing people usually tend to ask, is how do they pay off their homes so much faster using this type of home loan? And it comes down to whether you want to call it velocity banking or the maximized cash flow strategy. There are a lot of different terms for this. Today, when we talk about velocity banking, that's what we'll be referring to, is the strategy that you use when you have a first lien HELOC. So it basically leverages the difference or the differences between an amortized mortgage and HELOCs. So we have to understand, right? If we're going to understand how do people use this loan, first we have to understand how it works and what are the rules that it follows for us to be able to leverage. And so velocity banking, kind of like I said earlier, is this method. It's the process that people use to pay off debt faster by using lines of credit. You can do it with a personal line of credit. You can do it with a credit card. You can do it with a second lien HELOC. A first lien HELOC is the most efficient and effective vehicle to utilize this velocity banking strategy. And it's what we specialize in to help teach people this concept. So, so the difference is, there are two main differences between an amortized mortgage and a first lien HELOC. One has to do with money flow, and the other one has to do with interest calculation. So if we're going to talk about money flow per se, if you think about your amortized mortgage, you can, it's a closed-ended loan, and you can put as much money into it as you want. But once the money's in there, it's locked away. You can never take it back out. If we compare that to a first lien HELOC is called an open-ended loan, which means money can go in and out freely. So what that means is you can safely put as little, you can safely put as much. If you wanted to, you could safely put every single dollar that you have toward this mortgage product to pay it down as much as you want, because you can take it back out, because that's how this loan functions. That understanding is a core understanding and a core factor to understand, because that's what allows for this whole strategy, this process to be feasible. The second difference has to do with how it calculates interest. The interest calculation is actually really important, because when you can take advantage of it, when you understand how the interest calculation is created or how it works, you can take advantage of that reality to help yourself save money. So with an amortized mortgage, it does a monthly calculation where it looks at, or it uses the previous month's end balance. And it uses that end balance against your interest rate to calculate your payment. And that's the calculation that it uses. The right first lien HELOC, and I was reminded that I have to use the right first lien HELOC language, because I don't actually know if every single first lien HELOC calculates interest using a daily calculation. But the right one for this strategy uses a daily calculation, which means it doesn't look at the previous month's end balance. It uses the average balance of the month, the average daily principal balance against your rate to calculate your payment. So if we think about how averages work, right? This is a visual representation of 30 days balances. I know it's not great, but if you imagine each one of these tick marks as the balance of each day, each day's balance, right? And this black line is the average of those, right? If we want to create the lowest balance, I need to create the most number of days with the lowest balance, because that results in the lowest average balance. So because I've got a bunch of days, I want to create the most number of days with the lowest balance. Well, that starts on day one. That starts with me putting money in there as fast as I can, because I don't want to wait 5 days to get money in. I get money in as fast as I can to pay it down as fast as quickly as I can. And I don't want to put a few dollars in there to create kind of a low balance. I want to create the lowest balance possible, because that affects my average balance as much as possible, saving me the most money on interest costs. So we talked about controlling your money, controlling your future. This product allows for you to control your balance and control that average balance in a way that you simply can't with an amortized mortgage. And so this understanding leads into the first part of the process of the strategy, of the velocity banking strategy, which is if we want to create the lowest balance possible as fast as we can, that's exactly what you do. You deposit all the income into your first lien HELOC, and that pays your balance down as much as possible, as fast as you can, creating the lowest balance now. Well, now all the money's in there, and you have to pay your bills. Well, if you have an amortized mortgage, you can't pull from it. You can't take from it to pay your bills, which is why you don't put all the money into your amortized mortgage. But here, remember, money can flow in and out freely. So it's exactly what you do. You use your first lien HELOC to pay all your bills, and that increases your balance. So at the end of the month, you've decreased your balance with everything you have. You've increased your balance with your expenses, and all the income that's not spent, all of the surplus is simply paying down the home. That's what pays down the home month over month, is every single dollar of your surplus. So essentially what that means is that if there's no money anywhere else, there's no faster way to pay this down, because you can't overpay. This is the max overpay possible, because everything is in here at this point. So then the question is, who does this work for, and who does it not work for? You know, because with any single offering any single process, any single decision that you're going to make. There are going to be some people where it's great for, and some people where it may not be quite as good. So if we think about one example, this household, they owe $300,000 on the house. They bring in $10,000 a month, and their total spend is $7,000 a month. Now, this household, given that budget, makes more than they spend. There's a surplus every month. And so what happens, you guys can probably guess, right? 10,000 goes in, pays down to 290. They pay their bills of 7,000, which means at the end, and it goes up by 7,000 to 297, which means at the end of that month, they've paid down their house using all of their surplus by $3,000. That's the end of the month. Well, next month they get income goes in, which pays it down by 10,000. They pay their bills of 7,000. And so at the end of that month, they've paid down their house by $6,000 total. Now, this is a little bit of an oversimplification, but to understand the concept, it's a way for us to display it and show it in a way that is sound. So in this scenario, with a $300,000 balance, and I'm using a 7.75% rate, 10,000 income, 7,000 expenses, they pay off the home in 7 years and 1 month. Total interest cost would be $90,148. That's the same cost as a 30-year fixed rate mortgage at 1.83%. Now, remember, on paper, we're assuming a 7.75% rate, but the total cost, the cost of funds, the amount of interest that you're giving the bank is the same amount that you would as a 1.83% 30-year fixed rate mortgage. Now, if we compare that to a 30-year fixed at 3.5%, you would give them $184,968. So there's a savings of about $90,000, even with a higher rate, simply because in this scenario, they can pay off the house that quickly. So if we think about another household, family B, they also owe $300,000. They also bring in $10,000 a month, but their expenses are $9,500. They're a little tighter on their budget, right? Not quite living month to month, but there isn't a ton of surplus here. Pay down the home by $10,000, they would increase by $99,500. That month, they'd pay the house down by $500. Next month, $10,000 goes in, $95,000 goes out with their expenses. And at that point, they would have paid down the home by $1,000 over those 2 months. This household, with that budget, would result in a 30-year plus payoff. Total interest would be $497,500. That total cost is the same as a 30-year fixed rate mortgage at 8.067%. This particular household would not be a great fit for this particular product just because there wasn't enough surplus to pay it down fast enough to overcome the higher rate. So all in all, what this whole concept is, it's as simple as addition and subtraction. It's not complicated math. It's just a new way of approaching something that we all are ingrained to think needs to work a certain way, but it leverages all the cash flow to pay down debt. It only works when there's a surplus. It isn't a great fit when the household's tight on their budget, but when it works, it can result in very short payoff times, and people can save tons of money when it works as well. So that is the velocity banking strategy in itself. I'm going to hand it back on over to Jason to lead into the second part of this, because this is just part of what this holistic option and opportunity provides. And I would be lying if I didn't think that Jason's part was actually more valuable than what I just went through. So I'm going to let him take the reins if that's all right.
All right. All right. I will, let's see, share my screen again here. Okay. So, again, let's take this part one, this deck of cards, and put it on the shelf for a minute. Velocity banking and first lien HELOC. So that velocity banking, as we talked about, refers to the speed of paying off your mortgage. And people have to store money somewhere, and all the money is stored in this vehicle, right? Your excess, as Anthony was explaining, and you pay your bills from that. But the effect, the end effect, is paying off your mortgage faster, building up your line of credit even more, and you can use that to take that in this context, right? We'll take that excess and use it to make us money or save us money elsewhere. But now we've got a way to easily tap into an increasing equity line along the way. So, but what if you could use some of that equity that you now have access to to expand your own privatized family banking system, which I'll talk about now. So enter the infinite banking concept. Some of you have heard me talk about this before. I think everybody should pick up this book. I'm not here to peddle books, but pick up this book. You get on Amazon, you get on my website. It's only 92 pages long. It is the foundation of everything we do as it relates to the infinite banking concept. Okay. And again, this is about the concept itself. Okay. And I want to talk about this. This is the process, kind of where I talked in the beginning about the process. So the infinite banking concept is a process, it's not the product. It's about controlling the banking function in our life. It's about how do we position ourselves in our lives to be in control of our money rather than constantly giving control away. And that's what the concept is about. You know, it really is the best place to warehouse our wealth, right? We want guarantees, we want safety, we want access to our money. We'd like to replace the need for the outside bank over time if we could, wouldn't we? Wouldn't you like to be your own banker? Wouldn't you like to borrow from yourself instead of the lender, and get yourself in that position? Okay, so the vehicle through which we show people how to do that is properly structured dividend paying whole life insurance from a mutual carrier. Say that 10 times fast. But I'm wordy about it because I'm particular about it. It's not just, hey, go get life insurance. It's not go get whole life insurance. It's not that simple. It's properly structured. It's structured in a very particular way to maximize cash value access that you can then utilize elsewhere. So if you don't know, if you aren't familiar with it, you know, whole life insurance has a cash value component to it, unlike, say, term insurance. And that cash value you're allowed to borrow against. And you can utilize that money however you see fit. So we'll want to use it for real estate investing. We'll use it to replace the need for the outside bank. As that pile grows larger and larger, we replace that need. But anyway, so I say properly structured whole life insurance for today's conversation. We're only talking about whole life insurance. Dividend paying from a mutual carrier. We say that because there are two types of insurance companies. There are stock-owned insurance companies, and then there's mutual carriers. Stock-owned companies, right? Interests are for the stockholders, and a mutual carrier is a policyholder. You're one of the owners of the company, thus entitled to the profits, which come in the form of dividends. So that's why we say dividend paying from a mutual carrier. So anyway, so don't just rush down the street and run into that sidewalk shop and say, hey, here's a bunch of money. Give me some life insurance. I'm going to bank with it. There, you're going to get something wrong. I've actually had that happen. I had a guy do that. He went down and he got a policy from someone else, and then called me back and about 6 months later and was like, you this is wrong, you lied. And I said, let me see what you got. And it was structured all kinds of wrong, and it was unfortunate that it was just done that way. But anyway, so that's the vehicle through which we show people how to do this. Okay, the idea behind it is you're putting your money into this vehicle. So let's call that the save component. You put it into the vehicle. You can use it along the way. So you can save, you're going to borrow against it. You use it for, in your case, real estate investing. We replenish it. If we're borrowing from ourselves, we want to be an honest banker and pay ourselves back. And then rinse and repeat, because every penny we pay ourselves back is there to be used again on something else. All right, so that's a high level. Let me give you some overall benefits of it, and then we'll drill down into a specific case study for real estate investors and infinite banking, and then we'll tie the two together at the end. So privatized family banking, I call it. I think the single greatest benefit is that your cash value inside of your policy will grow uninterrupted throughout your entire life, even while you're using it. Let me say that again. The cash value inside of your policy will grow uninterrupted throughout your entire life, even when you've borrowed against it and you're using it elsewhere. Okay, any other vehicle that does not do that. If I put my money into just a savings account and I got a high yield savings account at 5%, and I take out 3/4 of that money, it's only growing on what I left in there. Right? Makes sense? Any vehicle does that because you pulled it out, you pulled the principal out. And inside of your policy, the cash value grows uninterrupted. So if I borrow against 3/4 of it, whatever's in there, it's growing as if the whole amount is still in there. Okay, I think that's the single greatest benefit in my opinion. It's a guaranteed growth. You know what it's going to do. It's a guaranteed growth. It is income tax-free growth. The longer you have the policy, the more it's compounding, the more your cash value is, and that cash value will exceed what you put in there. And it is income tax-free growth because of how it's structured, because of how you access it. Okay. It is not an investment product. It is not market correlated. It is an asset. So it is safe from investments busts, call it. So you're not going to have whatever outside markets are doing is irrelevant. Okay. And then unstructured loans, when you borrow against your policy, it's an unstructured loan. You get to dictate how you're going to pay it back, when you're going to pay it back. Am I going to pay it back in a day, a month, a year, 6 years? Never. That's your prerogative. But it's unstructured. You get to decide. Loans are not tied to your credit. How nice would that be? You can use it now throughout your entire life and even use it to supplement your retirement later on an income tax-free basis even. Plus it's life insurance. So we have a generational wealth component to it. Lots of benefits just on infinite banking alone. Okay, various ways we can use it, of course, real estate, personal legacy planning. You have access to capital, private money lending, liquidity for opportunities, personal financing, emergency funds, retirement income, legacy planning. I mean, lots and lots of ways you can use it. Okay, let me dive into one case study for IBC and how one man used it for purchasing rental properties. And then we're going to tie them together. And let's dive in. So when we met, he was purchasing small 1 and 2 bedroom rental properties in small town Midwest. And it was a college town. And so he was getting them for like 50, 75 grand a pop. And would pay cash for them and then rent them to the college kids. So when we met, he already had 18 of these. It was working. His system was working. I'm not here to change your real estate investment strategies. I'm here to change the flow of your money. What direction does your money flow and what does it do for you? So I didn't want to come in and say, okay, well, let's not do that anymore, do something else, right? That he was working for him. And so, but he was taking the free cash flow from the rental properties and putting it in a savings account. And as he would have enough, he would go buy another property with it. And I've run into that situation quite often. Maybe that's you today. And he had a day job, so he didn't really need that income anyway. He was just stockpiling to build up for passive income for retirement. So anyway, he was putting away $36,000 a year into a savings account. And so we said, hey, what's it look like if we put that 36 a year through a properly structured policy instead? And how would that grow and how would that benefit you along the way? Well, I don't know. Let's look at it. So we built a policy. I'm not going to break down all these numbers. Don't get scared of the numbers. And actually, now that I say that, time out. When we show you examples here, don't get caught up on the number of zeros, whether it's this policy, whether it's the case studies we show you on the First Lien HELOC. Principally, it works the same no matter how many zeros are on here. Okay, so this guy, 36,000 a year, make it 3,600 a year, make it 360,000 a year. I don't care. Principally, it's the same. Okay, just understand how it works. Okay, in his case, we were going to do 36,000 a year for about 10 years. You see where the red box is, and then we were going to reduce premiums after that. Okay, so when you put in premiums, year 1, year 2, your cash value is not growing quite as much, and then its compounding really kicks in after that. But if he were to lump sum 36 in day 1, he could turn around and borrow day 2. So we built this big calculator, this big spreadsheet for him. And if you like spreadsheets, you and me are going to get along. Okay. So we built this spreadsheet and we said, okay, let's put in 36. You can see my highlighter over here. 36,000 a year is his premiums. He could only get 22 and change back out that year. So he couldn't do anything with it, but he was buying them for 50 grand a pop in this example. So he still couldn't do anything with it, even if it were just 36 cash sitting in his bank account. Okay, so year 1, 36 into his policy, and we didn't do anything with it. Year 2, we put 36 in down here, and we had enough to buy a property. And so year 2, we went in here and we bought property number 1. Paid 50,000 cash. You see the loan over here. I don't know why the arrow pointed. Anyway, so 50,000 loan against his policy. And he paid cash for the property. He was his own banker in this case. So he loaned himself the business, or he loaned his real estate investment business the money, and he set up a mortgage to pay for rent through rental income. It's going to pay its own loan back, the 50,000. So he set up a 20-year AM loan at 4%. And that's where that came from. Okay. So $303 a month is what that amounts to. Make sense so far? All right. So then that's year 2. Year 3, he put 36 in down here. There wasn't quite enough. There's 39,000 in cash value built up in here. Not quite enough to buy a second property. So we do year 4. Now that's up here where the red arrow is in the middle now. Year 4, we paid 36 in premiums again, but now we've got 50,000 in cash value. We go buy property number 2. Sets himself up with a second 20-year AM loan at 4%. It can be whatever you want, right? This is an unstructured loan. We just decided this makes sense. Okay. It was costing him 4%, so we charged 4%, zero it out. So that's why you see his repayments in this green column over here jump from 303 to 606 a month. Okay. 2 properties. But something interesting happens. Remember, I talked about the uninterrupted compounding growth. This is 4 years in. We had to skip year 1, skip year 3. Now we're at year 4. But the growth is such, year 5, he puts 36 in down here at the bottom. But he can get 50 out all of a sudden. So now he puts 36 in, he has 50 there, he borrows and he buys property number 3. Sets himself with another, we just said, hey, let's do the same mortgage analysis, right? And pay itself. So you see his repayments jump. Now he's compounding. That was year 4, year 5. Year 6, he put 36 in, he could get 50 out. He bought property number 4. Year 7, 36 in, 50 out, property number 5. Year 8 again. And this can go on in perpetuity because the compounding growth inside of the policy is larger every single year now. So he's putting 36 in, pulling 50 out, and going and buying a property with it. But now you are your own lender. So would you steal from an outside lender? No, you would not. So that's why you want to pay yourself back. Just be an honest banker, pay yourself back. So all these repayments, this 303 a month per property is now amounted up to, let's keep going. We bought 10 years in, we've bought 8 properties in 10 years. And that's 27 a month in payments back to himself. Every penny paid back to himself is there to be used again on something else. So now you have 2 growth vehicles. You have your principal vehicle growing because of premiums and dividends. And then you've got the loan repayments adding to that pile also. And so you can see on the far right where that arrow is, his cumulative cash value growing year over year over year. This is month over month, actually. So every dollar repaid is there to be used again, plus your compounding growth of the policy anyway. Fast forward, in his case from, let's see, this box at the bottom is year 17. Year 16 to 17, he paid 12,000 in premiums. His cash value alone grew 36,000. Plus, he recaptured that 2,700 a month in repayments. So we had a cumulative increase of $52,000 that year. Okay, and that's uninterrupted comp. He's got $200,000, $300,000 in cash value sitting there. Could he have kept buying properties? Absolutely. We just wanted to stop it just to show like how much that's growing year over year now. And he can use it for whatever he wants. So you see, just that's the power of just utilizing the infinite banking concept and utilizing properly structured whole life insurance to replace the need for the outside bank. And we all have that need. So now what do we do with this, right? We're gonna put these 2 ideas together. And Anthony and I got talking about a year ago, and that's what happened. He's into First Lien HELOCs, I'm into IBC, and we're like, dude, I know, I'll bet you we could find a really nice way to make these work in tandem with each other. And we spent a lot of time kind of unpacking this, and I'm every day I explain this, I'm so excited. I'm like, this is so cool. And it's just exciting to see it work and excited to see it work for people. So again, velocity banking, is this idea to become mortgage free in record time, like Anthony talked about, and you can save tens or hundreds of thousands of dollars in overall interest. Infinite banking, along the same time, you're building this equity on that side. Infinite banking, you're building this other pile of equity, this accessible, we call it a line of credit. It's not a line of credit, but it's your cash value that you have access to, and utilize it however you need. You building this other warehouse of wealth along the way. Okay, so then here's overall, and I'm going to hand this back to Anthony here. The overall idea on linking them to, this is more of the strategy side. Okay, Anthony, you can jump in anytime you want, but we want to really get this first lien HELOC and get that dialed in.
I just took over, I think, Jason.
What's that?
I think I just took over.
Okay.
Can you see it? Is it working?
No.
So, okay, so what Jason mentioned earlier is that we've got two different outcomes that I think are great, right? One is you have the ability to have this mortgage product that works differently to achieve the goal of paying down debt and becoming debt free. That's something that we teach and we focus on a lot of times. And then at the same time, you get to build this amazing, robust life insurance policy. And a lot of times people see them as being an individual. I have to choose between one or the other. And I think that's maybe something that Jason was trying to arrive at or get to, is that when we came together, we were like, there's got to be a way that you can leverage these two products at the same time to get both, right? To be able to pay off the home really quickly or have the liquidity with this vehicle to achieve different goals, while also being able to create an extremely robust life insurance policy that can serve as your personal banking system and that can create a death benefit and a cash value that is amazing and serves in that way. So that's what we spent our time doing, is brainstorming through how both of these work individually to figure out where the opportunities that we can marry the two so you can have both outcomes. And so that's kind of what we came up with. And so that's where this linking the two comes in, is that the strategy that we learned and the strategy that we came up with is one that uses these two together. So this is essentially the way that you accomplish that, the way that people accomplish this, to be able to achieve both of those goals at the same time. So first thing is you get a first lien HELOC, you start velocity banking, income goes in, used to pay your bills. That's just part of the process. Then what you do is you pull from the HELOC, the available equity in the HELOC, to fund your policy to whatever is the amount that makes the most sense for you in terms of how Jason would advise, if that makes sense. So right now you've pulled from the HELOC, you pulled from the equity, you've increased your balance on the HELOC to fund your policy. Well, remember, you can pull from the policy as well. I don't use correct insurance terminology like Jason and Steve would probably prefer that I do, because I don't know it as well in the space. But the way I like to think of it is, you're not borrowing from your policy, you're borrowing from the general fund of the insurance company, because the amount of cash value that is created, that full amount still generates interest. When you borrow against the general fund of the insurance policy, the full amount of your cash value doesn't get changed in terms of what's generating interest. But what you do is, first you use the HELOC to fund the policy. Then you pull from the policy and put the money back in the HELOC to pay the HELOC's balance back down. So again, you've pulled from the HELOC to fund the policy, you turn right back around, pull from the general fund of the policy, it's Anthony's language, and you put the money back in the HELOC to pay it down. The idea here is to use the HELOC to fund the policy, put the money back down, and then with the money in the HELOC, you continue to drive down the balance of the HELOC until it's paid off. So what you do is you fund the policy and pull money back into the HELOC every year, right? Pull from the HELOC, fund the policy, put the money back in the HELOC until the home is completely paid off. And whether that's 3, 5, 7, 8, 9 years, that's the first step. But then once the home is paid off, you've got all this cash flow that was being dedicated toward paying off the home. Well, during all those years, remember, you're borrowing from the general fund of the policy. So you do need to pay that back. That's a core tenet of that. There are a couple things that I've taken from Nelson Nash's rules. And one of those is that you always have to pay yourself back because you're the bank. And so once the home is paid back, once the home is paid off, you have all this cash flow and you direct all that monthly free cash flow toward the policy loan until that's paid off. And that can be, so that's the general strategy here. And so, and what you get is you get both outcomes. You get a fast payoff, you get to save interest, you get a high cash value policy that serves as your personal banking system, which again, I know I'm the HELOC guy, but I do like the value that you get. I mean, I'm not just the hair club president. I'm also a user, right? I also I have a policy as well because I believe they're an extremely valuable asset to have, and so you get both in this situation. You kind of get your cake and you get to eat it too. So
And
so
kind of capping this on, capping this off on that part, and we can go into case study, but I just want to say like this strategy right here, this 1 through 5, right? This is generalized, right? Just like we've got questions on how much do we put into the policy? Have been coming up in the chat. How much do we, these kinds of things, we'll work with you individually to come up with your own strategy that works for you and your own numbers, right? So this is not this you have to do step 2, step 3, step 4, right? We will run numbers through a calculator. We'll show you and help you figure that out. I just wanted to point that out.
yeah, just like with any strategy or concept or new lesson that you're teaching, it's best to introduce the concept in a very structured format so that way people can connect with that structure. The reality is that both the HELOC and the policy, you have a lot of flexibility with how you use it and leverage it. Jason and I both know each individually backwards and forwards, and we also understand together how to make it work for someone. So again, although we introduce it with a very strict and static reality, it's in order to help people connect, to help you guys connect with what you do, right? This is basically what you do, but again, each situation is particular to the individual and the different types of outcomes that you want, the different goals that you have. Both of us can help you structure this in a way to help you best achieve what you're trying to accomplish and with your reality, because it is individualized. So yeah, I appreciate you saying that. Yeah, absolutely. So we did have we put together a case study, an example. So remember, in this scenario, we've got a first lien HELOC that we're using the velocity banking strategy, and we're building a properly structured life insurance at the same policy at the same time. So the top section are the assumptions that we made for this. So we assumed the person owed $320,000 on their home right now, that they have 26 years left on their current mortgage with a 4.5% interest rate. So that's the scenario we're looking at. Their current net income is $12,000, and their average monthly expenses, not including PITI. So I want to keep in mind, like, this is not someone who brings in $12,000 and spends a total of $5,500, including their mortgage. It's really more someone who brings in $12,000 and including the mortgage, if they have 26 years left, probably is spending closer to $75,000, maybe $8,000 a month. Again, a fair amount of surplus. And then it says monthly escrow, it really should be annual escrow of $4,800. So that's the assumption that we're making with this household in terms of if you were to integrate the strategy, what would, who are we looking at? So Jason, you can go through the policy part.
Yeah, and with again unpacking it and this situation, there's enough equity in here, and we push it through our calculator, make sure it makes sense. In this case, we're going to show you they would fund a policy. They'd put $60,000 a year through a policy the first couple of years, and then we'd reduce premiums. You saw in my case study how the first guy, he was doing $36,000 a year. He reduced it down to $12,000 a year after 10 years. So we can structure them a lot of different ways. So in this case, year 3 onward, we're going to reduce it down to 12. Certainly you could fund it more ongoing. But then we're actually going to borrow when you put money, you fund your policy, but then you can borrow against your policy right away as soon as it's funded. So we're going to actually borrow back from the policy against the policy and put that back into the HELOC, because the policy loan rate's a lot lower than the HELOC rate. So we're kind of recapturing that debt in a way. So we'll fund the policy, borrow the first couple of years and put it back into the HELOC. And then years 3 through 5, we reduce that borrowing amount, and we'll kind of show you the impact of that here on the next slide.
Yep. So if we look at the progression year over year of what they would do and what they'd experience. So for the first 2 years, at the beginning, they get the first lien HELOC, they start the strategy. Like Jason said, for those first 2 years, they pull $60,000 from the HELOC to fund the insurance policy, and then they borrow against the policy or the general fund to put back in the HELOC. So pull from the HELOC $60,000, put $45,000 back in, And each month, using that velocity banking strategy, they would pay down the home by about $34,000 per year. It increases year over year, but that's what the first 2 years look like. Between years 3 and 7, we pull from the HELOC to fund the policy. Now, the amount that we were pulling from that year was not $60,000. It was close to, I think it was around $12,000. So first 2 years, it was pulling $60,000. Years 3 through 7, you're pulling $12,000 and putting it into the policy, and you're borrowing, I think, $8,000 from the policy and putting it back in the HELOC. So again, you're pulling from the HELOC to fund the policy, putting the money back in the HELOC for the purpose of paying off the home as quickly as possible initially, right? So between years 3 and 7, you'd pay down the home by an additional $173,000. And during year 7, the home would be completely paid off. So home's completely paid off. But now remember, we've been borrowing from the policy the whole time, so we have to pay that back. So between year 7 and year 10, you have all that additional cash flow. All of that cash flow then gets dedicated toward paying down the policy loan that you took. So it takes about 3 years for that to pay off. So that's the general, in terms of with this particular scenario, that's what happens with this example. So we do have a calculator. This is just kind of what it looks like from our standpoint that we built. From a First Lien HELOC standpoint, you've got the policy part in the middle, and then on the right, it calculates your current mortgage and scenario, so we can compare your current scenario to what it would look like if we were to build this out. This is what we see, but it's sort of the input page that we use, just so you guys have a good idea as to what we're looking at as we build this out.
And you'll see in the middle there that like we can play with the policy loan structure. You know, does it make sense to borrow right back out and pay down the HELOC, or would it make sense to keep that capital there and use it for something else? You do it halfway. You don't have to borrow all of it. You can borrow some, you know. So we can play with those numbers with you and figure that out, and it'll show us the math. You know, what makes the most sense, and
absolutely
how Anthony and we were playing with it and just figuring it out. And
it was interesting because there were some things that we made assumptions about that when we ran a couple different scenarios, the math proved to be a little bit different than what we expected. I know I thought I was right all the time, but I guess I'm not. So so it's okay. I'll take that. You can ask my wife; she'll probably tell you the same. But so if we think about what you receive, what this household receives in this scenario, they receive a policy, right? An infinite banking, properly structured life insurance policy with a cash value of $252,000, a death benefit of over $1.5 million, and a private banking system that's set up for them. And they also, with the First Lien HELOC strategy, right? They receive a paid off house, right? 16 years faster. They'd save over $140,000 in interest, and they'd have an equity line of $467,000. So if we put those together, the total liquid funds, you've got $467,500 in a First Lien HELOC that's available immediately, and a cash value of $252,570 for a total liquidity, we'll call it, total amount of liquid funds of $720,070, simply by being smarter with the systems that you use and the vehicles that you utilize to achieve a goal, right? And so, so all in all, that we were really happy to come across this, because when we first came together, we didn't know if the math would prove out correct or not. And when we ran a number of different scenarios and over and over and over, we realized that this works, and it leverages the benefits of the two systems that we have to get a much greater outcome than we could without it. That I think that's what really drove my excitement, and wanted to, we just wanted to share.
Yeah, that's right. So again, it was from a fire hose. Let's go on to the next slide. We know this is a lot of information. Okay, so I'm going to share my screen actually.
Yep.
And pull this ahead. But we know this is a ton of information. And so we built this course. You have the option of taking this course. I'm going to share my screen again. Sorry, guys. All right, we have this advanced course you can sign up for. It's $49. Actually, we have a code the National REIA wants to give you guys $20 off that course if you want to take the course. It's just an advanced look at what we're talking about today. So you can scan that QR, go there, sign up, enter code NREIA at checkout, and you get $20 off that course. If you're like, man, I've heard enough. I want to see if this works for me. By all means, scan this QR, go to that page. This will allow you to fill out a quick form. We'll send you the cash flow worksheet. That cash flow worksheet is important. Fill that out as detailed as possible, and then go back to that page and then upload it to us, and you'll schedule a call by doing so. You'll upload it and it'll ask you when you want to talk. And we will look at this cash flow spreadsheet and help you determine, is this whole package potentially good for you? Is it bad for you? Is just one or the other good for you? We'll help you navigate that. But the cash flow worksheet would be the very next step to utilize in that regard. Okay, so I'm going to pull this slide up and then we'll stop and I'm going to kick it back to Rebecca or Lori. If we have time for Q&A, we are good to stick around. But again, you can sign up for the advanced course. If you want the discount, enter code NREIA at checkout for $20 off. If you want to go ahead and get started on the cash flow worksheet, do that, fill that out, come back and upload it, and we will talk. And if you have questions, certainly you could email us at ibc@1024wealth.com. You scan that code if you want to just schedule a quick call. And we could go from there and talk. Guys, thank you for your time. We're going to kick it back to you guys.
Thanks so much, Jason. I'm checking the chat bar. There have been lots of questions. I think one of the easiest things to say is that this is customizable. So just kind of making that clear. There have been examples given, but none of those are requirements in terms of contribution levels. I was saying in the chat bar that both of my children, who are now young men, have policies like this that are working for them. And of course, they're contributing at a much lower rate than some of the things shown here, but it's still working well for them and they're moving into these concepts. So don't think that, especially with the straight IBC concept, that you have to have a huge dollar amount. Am I saying that correctly, Jason?
Yeah, that's right. That's right. And don't write yourself off too. Don't self-eliminate. Let's have a talk. If you're interested, let's at least talk. Don't be like, oh, I think I saw a comment earlier about someone being 65. That's not a non-starter. That's we have started people in their 70s even potentially, but you also have people around you that are insurable. So that we have options. You just need to talk to us and we'll help you unpack what we can.
Same thing's true with interest rates and kind of the longer term plan, how long to do this. I think those are all things that will be customized to the situation of the individual, what it is they're trying to buy, what it is the position they're in, that they're getting the HELOC to replace. So I think trying to answer specific questions without having all the information is something that probably shouldn't do here. So definitely make sure you reach out to the team to ask those specific questions. This definitely will be on a replay. It'll be posted to the YouTube channel for National REIA, so you'll be able to see it there. And I'm just trying to scroll and see if there's a lot of questions here. You can check out the chat panel over here. So some questions have been answered here, but for the most part, it's just easier to reach out and get kind of customized answers to the questions that you have by reaching out to the team. The other thing is go ahead and fill out the worksheet so you kind of know where you are in the process, and it gives the team kind of more information about you so that they can give you more detailed information to work with where you are.
Sorry.
Any other questions for the chat?
Cool.
Awesome. I think we're all good. Well, I'm going to go take the course. I'm going to make Andrew pop on right after this and do that as well. I think it can be a really good solution for those of us that are still out there purchasing.
Mm-hmm. That's great. Yeah, guys, reach out. We look forward to chatting. And again, if you need to just schedule a quick call to get on with us, You'll get myself or Stephen Labella on here, and we will get you answered.
All right. Thanks, guys. We really appreciate your being here. This is a really interesting concept that I'm actually super excited about. So I can't wait to dig in further. For the rest of you, we will be back same time, same great bat channel next month. And Lori will be sending out the reminders, and you'll have all the access to that as well. Again, the replay is on the YouTube channel, and be looking out for Brad's new podcast. We're super excited about this. So you'll have that information that can be read to you while you're driving and moving through your day. Thanks again. Have a terrific day.
Thank you, guys.
Bye, everyone.
Thank you.